In March 2025, foreign central banks reduced their holdings of United States Treasury bonds by more than $82 billion in a single month. The pace was the fastest in over a decade. The trigger was an energy shock. Oil prices had surged. Currencies across the developing world were falling against the dollar. And the fastest way for a central bank to raise large quantities of dollars, the currency in which oil is priced, the currency in which most international debt is denominated, the currency in which most of global trade is settled, was to sell the most liquid dollar asset it held. For most central banks, that means United States government debt. This is what dollar dependency looks like in a crisis, not as an abstraction, as a forced sale. This is a deep dive into the geopolitical history of African economics, specifically the history of how African economies were wired into a financial system they did not design, in a currency they cannot issue, under rules written before most of them existed as independent states, and what that wiring costs every time a decision is made in Washington. The question at the center of this video is older than that sell-off by several decades. Why do African countries borrow in dollars, in a currency they do not issue, cannot print, and have no control over? Why does a government in Nairobi, or Lusaka, or Accra take on debt denominated in a foreign currency, knowing that every time that currency strengthens, every time the Federal Reserve raises interest rates, the cost of servicing that debt rises, not because of any decision made in Africa, but because of a decision made somewhere else entirely? The answer is not a policy failure. It is not corruption or mismanagement. It is structural. It was not chosen, and understanding it is the key to understanding why African sovereign debt crises keep recurring.
To understand the trap, it helps to understand when and how it was set. In July 1944, 44 Allied nations gathered at a hotel in Bretton Woods, New Hampshire, to design the architecture of the post-war global financial system. They created the International Monetary Fund. They created the World Bank. They established the US dollar as the world's reserve currency, backed by gold at a fixed rate. The institutions they built, the voting structures they designed, and the currency they placed at the center of global trade all reflected the economic weight of the countries in the room. Not a single African country was represented at Bretton Woods. Most of the continent was still under colonial administration. The currencies that would one day be issued by the Central Bank of Kenya, the Bank of Zambia, and the Bank of Ghana did not yet exist. The system was complete before the countries it would govern were independent. That's not a metaphor, it is the literal sequence of events. When African nations achieved independence across the 1950s and 1960s, they inherited an international financial architecture designed around a small number of currencies, primarily the dollar, the pound, the franc, and later the Deutschmark and the yen. These were the currencies that global investors trusted. These were the currencies in which oil was priced, in which commodities were traded, in which international contracts were written. African currencies, newly minted and untested, occupied none of those roles. The consequence was structural from the first day of independence. If a newly sovereign government wanted to borrow on international capital markets, to build infrastructure, to fund a health system, to finance the machinery of a functioning state, the investors it approached would not accept repayment in its local currency. They would demand dollars. The exchange rate risk, the inflation risk, the convertibility risk, all of it fell on the borrower. African governments had no choice but to accept those terms or forego access to international capital entirely. In 1999, the economists Barry Eichengreen and Ricardo Hausmann gave this condition a name. They called it original sin, defined as the inability of a country to borrow abroad in its own currency. The term captured something important. This was not a problem any single government had caused. It was inherited, present from the beginning, and it persisted not because African governments were fiscally irresponsible, but because the international capital market had been structured around currencies that African countries did not issue. Eichengreen, Hausmann, and their colleague Ugo Panizza updated this research as recently as 2023. Their conclusion was direct. Most countries are still trapped, issuing nearly every cent of their international debt in a currency that is not their own. The progress made is concentrated among a small number of larger emerging markets. For the majority of sub-Saharan African sovereigns, the condition first described in 1999 remains the reality today.
To understand why this matters, it is necessary to understand what it means to borrow in a currency you cannot issue. When the United States government borrows in dollars, it holds a structural capacity that no African finance minister possesses. In an extreme scenario, the Federal Reserve can create dollars. The debt can always, in principle, be serviced. This is not an argument for monetary recklessness. It is a description of a structural asymmetry that exists on one side of the borrowing relationship and not the other. When Kenya borrows in dollars, no such option exists. The Central Bank of Kenya can print shillings. It cannot print dollars. It must earn them through exports, through tourism, through remittances, or borrow more of them. Every dollar of debt service requires first acquiring dollars, and the rate at which shillings convert into dollars is set by a market the Kenyan government does not control, responding to forces the Kenyan government did not cause. For oil importing economies like Kenya, a stronger dollar does not just raise the cost of dollar debt, it raises the cost of energy simultaneously because oil is priced in dollars. The squeeze arrives on both sides of the budget at once. Debt service costs go up, and the import bill for fuel, fertilizer, and machinery goes up alongside it. The government did not change its borrowing. The Fed changed its interest rate, and the consequences landed in Nairobi. This is the trap, and it is self-referential. Countries borrow in dollars because investors will not lend in local currency. The dollar debt makes the country more vulnerable to currency fluctuations. That vulnerability justifies the premium investors demand. The premium makes the dollar debt more expensive. The expense creates the fiscal pressure that makes a default more likely, and a default confirms the market's view that the country was risky to begin with. The structure produces the outcome it uses to justify itself. There's a second mechanism that compounds the first. When the United States raises interest rates, capital flows toward higher-yielding dollar assets. Money moves out of emerging markets toward U.S. bonds. That capital outflow puts pressure on local currencies. Local currencies weaken against the dollar, and governments carrying dollar-denominated debt find, mechanically, that the same debt now costs more to service in the currency they actually collect taxes in, not because they borrowed more, not because their economy shrank, but because a committee in Washington raised rates to address American inflation. This is not a theoretical risk. It is a transmission mechanism with a documented history operating in real time. For most of the post-independence era, African governments did not borrow from private international capital markets in significant volumes. External debt was predominantly concessional, loans from the World Bank, the IMF, and bilateral creditors on below-market terms. The terms were not always favorable. The conditions attached were often painful, but the exposure to currency risk was more contained. Two things changed at the start of the 21st century. The first was debt relief. The Heavily Indebted Poor Countries Initiative and the Multilateral Debt Relief Initiative, completed between 1996 and 2006, canceled or restructured hundreds of billions of dollars in African sovereign debt. Countries emerged from the process with cleaner balance sheets and a signal to international investors that creditworthiness had been reestablished. The second was the global search for yield. After the 2008 financial crisis, the Federal Reserve, the European Central Bank, and the Bank of England cut interest rates to near zero and held them there for close to a decade. Investors in developed markets, pension funds, insurance companies, asset managers, needed returns. African sovereign bonds, with yields averaging 6% or higher, offered exactly what the developed world's bond markets could no longer provide. The investors arrived, the market opened. In 2006, Seychelles became the first sub-Saharan African country other than South Africa to issue a dollar-denominated sovereign bond on international markets. In 2007, Ghana followed, the first country that had received HIPC debt relief to access private international capital. The bond was oversubscribed. The signal was sent across the continent, the market was open, and investors were eager. By 2021, 21 sub-Saharan African countries held outstanding Eurobonds. The total stock reached $136 billion. Zambia's 2012 bond, $750 million, attracted more than $11 billion in orders, oversubscribed more than 15 times. At the time, this was celebrated as a sign of investor confidence in Africa's economic trajectory. It was also, structurally, the beginning of a debt architecture that would end in default 8 years later. African governments entering this market did not do so from a position of strength. Their credit ratings sat below those of comparable economies in Asia and Latin America. Their domestic capital markets were thin. Their financing alternatives were limited. Research published in the Journal of African Trade found that African sovereign borrowers pay approximately 4 percentage points more in interest than issuers in other regions with equivalent credit ratings. The premium reflects structural market position, the perceived risk of dollar-denominated debt issued by governments whose revenues are in currencies that global investors do not hold. Part of that premium is set by credit rating agencies, Moody's, S&P, and Fitch, whose methodologies incorporate political risk, governance assessments, and climate vulnerability in ways that consistently produce lower ratings for African sovereigns than for structurally comparable economies elsewhere. A lower rating means a higher interest rate on every bond issued. A higher interest rate increases the fiscal pressure that the rating was supposedly measuring. The rating and the cost it imposes reinforce each other. Kenya entered the Eurobond market in 2014 with a $2 billion issuance, a combination of 5-year and 10-year bonds. The proceeds were used partly to refinance an earlier syndicated loan and partly to fund infrastructure and energy development. Finance ministry officials described it as a sign of confidence in the country's economic trajectory. Kenya was one of the fastest-growing economies in East Africa. The access seemed earned. By June 2024, Kenya's external debt stood at 5.2 trillion shillings. The composition tells the structural story. Multilateral lenders, the IMF and the World Bank, held 51.5%. Bilateral creditors held 21.5%. Sovereign bondholders held 18.3%. The remainder sat with foreign commercial banks and supplier credits. The share owed to China, frequently described in Western coverage as Kenya's dominant creditor, was approximately 9% of external debt. The dominant creditors were and remain the multilateral institutions. Of that total external debt, 67.3% was denominated in US dollars as of December 2023, not Kenyan shillings, dollars. The currency Kenya earns primarily through tea and coffee exports, tourism receipts, and diaspora remittances, all of which fluctuate, none of which the government controls. Between March 2022 and July 2023, the Federal Reserve raised interest rates by 525 basis points, the most aggressive tightening cycle in 4 decades. The Fed's mandate covers price stability and maximum employment in the United States. It has no formal mandate to consider the fiscal positions of governments in Nairobi, but the consequences arrived there regardless. The Kenyan shilling lost 26.8% of its value against the dollar in 2023. The debt did not change. The interest rates on outstanding bonds did not change. What changed was the exchange rate, and because 67.3% of Kenya's external debt was dollar-denominated, that depreciation meant the same debt now cost 26.8% more to service in the currency Kenya actually collects its taxes in. The government had made no new borrowing decisions. Washington had raised rates to address American inflation. The bill arrived in Nairobi. Debt servicing costs surged by 40.8% in the 2023-24 fiscal year, from 1.197 trillion shillings to 1.685 trillion. The IMF classified Kenya at high risk of debt distress. The debt service to revenue ratio hit an all-time high of 101.4% in July 2023. The IMF's recommended threshold for this ratio is 30%. Kenya was spending more on debt service in that month than it collected in revenue. To close the gap, the government proposed new taxes. The Finance Bill 2024 included levies on cooking oil, bread, and sanitary products. The revenue increases were required to meet targets under the IMF program Kenya was operating under. In June 2024, demonstrators stormed Parliament. Placards read, "IMF, World Bank, stop the modern-day slavery." People were killed. The finance bill was withdrawn within days. The IMF program remained. The dollar debt remained. The next budget cycle began 6 months later. Meanwhile, Kenya's domestic borrowing costs tell a separate part of the same story. In 2023, yields on Kenyan government bonds in local currency were running at 14 to 17% annually. The rate on IMF concessional loans was below 1%. Borrowing in shillings, in the currency Kenya actually controls, cost 15 times more than borrowing from the multilateral institutions. The domestic market was supposed to be the escape hatch. Instead, it became another weight. Kenya's situation, as severe as it is, has not reached the end point. Zambia's did. On the morning of November 13, 2020, Zambia's finance minister announced that the country would miss a $42.5 million coupon payment on one of its dollar-denominated sovereign bonds. It was the first sovereign default in sub-Saharan Africa since the COVID-19 pandemic began. It was also the first in Zambia's history. The borrowing sequence that made the default possible began in 2012, when Zambia issued its first Eurobond, $750 million, at a time when copper prices were high, growth was strong, and the bond was oversubscribed more than 15 times. 2 more Eurobonds followed in 2014 and 2015, bringing total Eurobond debt to $3 billion. Interest payments on those bonds alone cost $237 million per year. Then the external environment shifted. In 2015, a drought cut agricultural output and disrupted hydroelectric power generation simultaneously. The kwacha depreciated more than 50%. A 50% depreciation on a dollar-denominated debt stock adds, mechanically, 50% to the cost of servicing it in local currency. Zambia's fiscal managers did not cause the drought. They did not cause the kwacha's collapse. Both arrived as external shocks and were transmitted directly into the dollar debt burden. It is worth stating plainly that fiscal decisions made in Lusaka also played a role. The post-2011 investment drive was ambitious, and some borrowing financed recurring expenditure rather than productive infrastructure. The IMF and World Bank had assessed Zambia at moderate risk of debt distress in 2015 and upgraded that assessment to high risk by 2017. Both the structural dollar exposure and domestic fiscal choices contributed to what followed. The evidence does not support placing the entire weight on either cause alone. What it does support is this. When the COVID-19 pandemic arrived in 2020, copper demand fell, the kwacha depreciated further, foreign reserves dropped to just over 2 months of import cover, and public debt surged from 61.9% of GDP in 2019 to 103.5% in 2020. On November 13, Zambia missed the coupon. The default had been building across 5 years of compounding dollar exposure. The pandemic accelerated the final stage. It did not create the structure. 3 years of restructuring negotiations followed. During those 3 years, Zambia's health budget was cut twice. Hospitals in 3 provinces reported medicine shortages. By mid-2024, Zambia's credit rating remained at selective default status with S&P and restricted default with Fitch. The debt was eventually restructured. The country that carried it was still rebuilding. Copper still accounts for 70% of Zambia's export earnings. The structural dependency that made the crisis possible remains intact.
Kenya and Zambia are not outliers. They are case studies in a continental pattern that the data makes legible. The average public debt to GDP ratio in sub-Saharan Africa nearly doubled in a decade, from 30% at the end of 2013 to close to 60% by the end of 2024, per IMF data. The ratio of interest payments to government revenue more than doubled over the same period, now running at close to 4 times the equivalent figure in advanced economies. In 2023, for the first time, African governments collectively spent more on interest payments than on education.
In 30 of 49 African countries with available data, the budget for interest was larger than the budget for public health. External debt service as a share of export earnings rose from 4.5% in 2011 to 14.8% in 2023. More than half of African countries assessed under the IMF World Bank Debt Sustainability Framework are at high risk of debt distress or already in it. Since spring 2022, when global interest rates began rising sharply, all sub-Saharan African frontier market borrowers were effectively shut out of international bond markets. The same investors who had eagerly oversubscribed African Eurobonds in 2012 and 2021 closed their positions entirely when global risk appetite contracted. Countries that had been praised for accessing private capital found themselves unable to refinance maturing debt on any terms. The only available option was domestic borrowing, at yields of 10 to 13% on average, compared to the sub-1% rates available through multilateral concessional lending. This is the final layer of the trap. Dollar debt does not just cost more in a crisis. In a crisis, it cuts off access entirely, forcing governments into domestic markets where the cost of capital is structurally higher, compressing fiscal space further, and concentrating government debt inside local banks and pension funds in ways that link the stability of the financial sector directly to the fiscal condition of the government. On a billion-dollar 10-year Eurobond, the 4 percentage point premium that African sovereign borrowers pay relative to comparable issuers elsewhere costs $400 million over the bond's life. That is $400 million that does not build a road, pay a teacher, or stock a hospital pharmacy. Across 21 countries and $136 billion in outstanding Eurobonds, the arithmetic of that premium is not small.
The standard institutional response to the original sin problem is that African countries need to develop their domestic bond markets. If governments can borrow from their own citizens in their own currency, the dollar exposure diminishes. This is correct in principle. The data on what it requires in practice is less encouraging. Since 2010, the volume of domestic debt issuance across Africa has tripled, rising from roughly $150 billion to nearly $500 billion. African governments now raise more than half of their financing from domestic markets. The shift is real, but the interest burden that comes with it has not fallen. It has risen. The African Debt Database, covering more than 50,000 loans and securities issued by 54 African countries between 2000 and 2024, found that multilateral loans carry average interest rates below 1%. Bilateral official lending is the second cheapest. Domestic bonds and treasury bills issued in local currency carry nominal yields of 10 to 13% on average. Borrowing at home in the currency the government controls costs 10 to 20 times more than borrowing from the World Bank. The reason is credibility, or more precisely, the absence of the structural conditions that produce it. International investors lend to the World Bank at low rates because the World Bank carries a guarantee from its member governments. They lend to the United States at low rates because the United States issues the reserve currency. They will not lend to the Kenyan government in shillings at low rates because they cannot assess with confidence what those shillings will be worth in 10 years. That uncertainty carries a price, and African governments pay that price every time they issue debt. The domestic debt shift does not resolve the original sin, it relocates it. The currency risk diminishes, the cost of capital remains punishing, and the concentration of government debt inside domestic banks and pension funds creates a new vulnerability, one where a fiscal crisis in the government becomes a banking crisis simultaneously. The escape hatch leads to a different room of the same building. The architecture built at Bretton Woods in 1944 was not designed with African governments in mind. 8 decades later, its institutions, the IMF, the World Bank, the credit rating agencies, the bond markets that price risk according to frameworks written by and for the currencies at the system's center, continue to operate by the same structural logic. The voting weights have shifted marginally, the fundamental asymmetry has not. The original sin that Eichengreen and Haussmann first described in 1999 endures not because African governments have failed to address it, but because addressing it requires changes to an architecture that the countries with the most power within it have the least incentive to alter.
The question is not whether this structure is unfair. The data on that is not in dispute. The question is what it costs in hospital budgets cut during restructuring negotiations, in tax bills proposed to citizens who marched against them, in the daily arithmetic of governments that must earn dollars to repay dollars, and whether the institutions that administer this system, whose stated mission is the promotion of global monetary cooperation and the balanced growth of international trade, have any structural incentive to change rules that have remained in their essential form since before most of the countries living under them were independent states.